So this is weekly commentary 33. Just a heads up before we begin the video. I'm feeling a bit unwell, so if I cough or sniffle, do forgive me because I'm sure I have some sort of flu, right? But let's get straight into it. Now, what did we have this week? We had the first week of October. So what does that mean? New monthly candle, right? Now, what did we see from September? September had that FOMC meeting, right? You see how it opened, right? Like a bullish candle, right? Open, low, create the high, and then it closed closer to the high, right? Now, we left this imbalance on this candle, and already we've come in and we've closed most of it. Now, there's a fair value gap from here to here, right? Do I expect that to get filled right now? No, I don't, right? It's clearly heading towards, for me, on the weekly, it's looking like it's gonna run for this buy side liquidity pool at this high, right? Now, if you have been on par with every weekly commentary, because there are guys that have been with me for a long time and they just are sticking with me for a long time, I don't know why, but you're gonna hear something that I ask you guys all the time, right? From what this candle done, right? So we had this fair value gap from this candle's high to this candle's low. This is a fair value gap, right? Is a buy side imbalance, sell side inefficiency called a BISI, right? Now, we had this candle dip into the fair value gap and reject off of it. Now, just from that small piece of context and what happened, what do you expect the next candle to do? Do you expect the next candle to trade lower or carry off that move, right, from here, or carry on that move off this level to reach for this buy side liquidity pool? How many times have we mentioned that throughout this entire mentorship in the weekly commentaries, right? I'm pretty sure we mentioned it for this weekly candle, right? This is, if you can apply this to your trading, because what I taught you just now, it is not just for the weekly time frame, it's for all of them. Now, this is part of open, high, low, close theory of the candles, and we're going to touch more on that today, right? Now, I'm expecting the DXY to now push up higher into this buy side liquidity pool, and it's also supported with the idea of, this on the US 10-year, right? We had this candles imbalance, right? We had this volume imbalance from this candles. You see this candles close here and this candles open. You see how it was, you know, it's different, right? We moved back down into that 50% of this candle and now we pushed away from it. So the next candle, what do you think it's going to do? Does it make sense for the next candle to move lower or higher? Just that. Just start with that on the weekly, right? Now, the guys that have been going through the content, once you have that week, right, that idea where you expect the weekly to go, what do you do then? You then conduct your weekly profiling. Let the Monday pass and conduct your weekly profiling. Where is the likely low and high to be set? And that is your backbone. That is your skeleton for day trading. And we're going to touch more on that as we're going to go through this weekly commentary. There's going to be a lot covered in this weekly commentary, right? So just the idea of the bonds wanting to push higher as well as the DXY, this is why I'm expecting this buy side liquidity pool to be targeted. Now let's go to the daily and touch on something. So we had this swing high be made, right? This swing high was made. Now, how do we know that's a swing high? The simple 3-bar pattern that I show you guys. We have a candle, we have another candle after it, and a candle after that. It's a 3-bar pattern. The candle in the middle, the high of that candle has to be greater than the high before, the candle's high before, and the candle's high after it. This is a swing high, right? Now, if I just move that down here, that's a swing low. When this candle's low is lower than this candle's low before it, and the candle's after its low, that's a swing low, right? Now, when you see that be made, right? When you're seeing that swing point be made, what do you expect when a swing point is made? The whole idea of a swing point being made is there is either going to be retracement or expansion. You see my point, right? Now, bullish market, a swing high has been made. What does that mean? Bullish market, swing high, retracement. Bullish market, swing low made, expansion. Remember that, right? We had this swing high being made. Now, when this swing high is made, This is when you have to think to yourself, where is the likely retracement to be made, right? And that is when, on the weekly commentary last week, we pointed to this fair value gap. We want to see the move down. We made the swing high. We want to see the move down into this fair value gap, right? We didn't quite get the completion of the market maker SAR model to here, right? But remember, you have to deal with what's in front of you first, right? You can't just marry that idea. Remember, I taught you guys, especially from the start of the weekly commentaries, you can't just aim for the lows and the highs. You have to consider the arrays before it because they provide a resistance to the run on liquidity, right? That's called a high resistance liquidity run. Or if there is less resistance in the way, that's a low resistance, low liquidity run. Right, now let's go back to the daily because this is quite important. This initial retracement, this is the retracement you want to see go to, equilibrium or OTE. Right, now use the swing point that is the most obvious to you, the closest swing point that is the most obvious with clear move away from it. This one, right? Cool. So now you have your swing low and your swing high. What are you expecting? You're expecting at least to move back to the equilibrium, right? But if we carry that on here, we see what within the OTE area, we see, in the discount of this range, we see that fair value gap exists there. So is it not logical to think that price is gonna dip into that fair value gap and provide us a discount market before going higher? Right, now let me remove the fib because now we've understood that we moved into a discount and price has now moved away. Now when we have that initial retracement and we get that displacement away, you see these candles, look at that displacement away. Where do you think price is heading to now? When that retracement is finished, that discount or that equilibrium is offered, preferably the discount is offered on the retracement, and you displace away from it, you have a swing low made in that discount. I don't know how many of you guys remember, but on the Snapchat private story that I have, I posted something to do with a fair value gap, a swing point being made in it, and once that swing point is made and the next candle is displaced away, your eyes go into the liquidity pool. I posted that on my Snapchat private story. I'm sure all of you are on it. And the reason I done that was because of this, right? You had the swing point being made on the DXY inside of it, inside of the weekly fair value gap. Because now what do we consider? Now this retracement is finished. We are anticipating what? The run on this buy side liquidity pool. Because the question I get now is, are we expecting from this retracement, this low that's finished, are we expecting OTE to OTE to OTE until the buy side liquidity pool is? The answer to that is no, because that's not how the market moves. Once you get that initial retracement discount and you displace away, you're now anticipating the run on this drawn liquidity. The retracements that you can look to be offered is turtle soups beneath candles lows into fair value gaps and then close and move higher and move higher. Essentially just retracement to fair value gaps. That's what you're hunting until you're getting the run on the buy side liquidity pool, right? That is so key because a lot of people, what they do is they get that retracement and now they don't understand that from this swing point being made in the discount, your attention now needs to shift to the draw on liquidity. I'm working my way towards this high now because people will just now keep waiting for, I'm gonna wait for the retracement and the retracement. And the thing is that retracement's not gonna come because that's not how the market moves and operates. That initial retracement from the first swing point, you want that to be discount, right? Equilibrium, preferably discount, right? From there, when a swing point is made and you are displacing away from it, then your draw on liquidity is evident, right? You are only framing retracements to fair value gaps to move higher. That's it. Not OTE after OTE after OTE, right? That's what you need to hunt. Now, I'm sure it was last week we spoke about midweek reversals. Now, what was the talking points on the midweek reversals? You have to time the day of the week with when price is trading inside of an array because time and price. The price are the arrays and the time is, of course, the day of the week, the time of the day we're considering on an intraday level. I'm just gonna remove this, right? So here, what did we have? These four up. Actually, let me just put this back on so it'll be easier. Let me just remove everything and place this. So I gave you guys this, right? There was this fair value gap, and there was these four candles collectively. They made one bearish order block, right? One, two, three, four. That makes one bearish order block. Now, what day hit into that, right? This was Friday, Thursday, Wednesday, Tuesday hit into that. Now, NFP week, you're done Friday, Wednesday. I don't recommend trading past the Wednesday because it's very likely Thursday can go into a very tight range, and Friday, without a doubt, it will go in a range before NFP, right? Now, for our sake of studying, let's look at this, right? Tuesday trades up into this higher time frame price array. Now, I want you guys to stay here with me, right? This is something that I was iffy to share because this, when I realize and see the market like this is essentially when my trading like took off exponentially and it never looked the same again. So, I'd rather us keep this to ourselves than, just keep sharing it about and about because what I'm going to teach you, most traders don't look like this, right? And even the guys that are chartered ICT members, this isn't taught to us. This was, I believe, we were all pushed to look at the chart like this, but I don't think a lot of us had you know, the drive to go on and study and find this. And you won't find SMC guys talk about this for sure. You won't find retail guys trading, retail traders talking about this as well. When we traded into the higher time frame PD array, right? You see how we displaced away from it, that candle, right? We're moving down away from it. I wouldn't even call this displacement at that point, right? But we had a move away from it. Now, you see, right, when you trade into your higher time frame PD array, you see how we are in a bearish market Euro USD because we're bullish on the DXY, and we now traded up into a premium array. You see how the candles, right? You see here, this is the key to the market that is in everyone's face, but that no one recognizes. OHLC, and what does that mean? I know if you're new watching this, this is gonna sound like what? This is like too much for me. I'm telling you, go through all the content. You're gonna come back to this weekly commentary, and it's gonna be the best thing you've ever watched, right? OHLC stands for open, high, low, close. Essentially, it's the anatomy of a candle, right? So every single candle opens, right? This is the low, right? Look, stay here, watch this, right? Put your eyes here while I go on a candle. You see how I move candles and they all change, right? So let's look at this big up close candle. The open of the candle is 0.98254, right? The high of the candle, which is the top of the wick, comes in at 0.99998. The low comes in at 0.98063, and the close is 0.99863. Now, why is this important? The open, high, low, close. Why is this important? Because when you're in a bearish market and you trade up into your higher time frame PD array and you displace away, remember chapter 4, lesson 1. Does this not look so similar to what I taught you guys in chapter 4, lesson 1? Right? You now have what? This low is our draw on liquidity, 0.95335, right? The low of this candle, right? 95361. That's our draw on liquidity. Now you see when we traded up into a higher time frame PD array, and we're displacing lower, the highs of the candles, we do not expect them to be traded through. We expect now the highs of the candle to be what? Intact. We don't, in a true, this is the algorithm, right? This is on my studying of the algorithm. When it is trading off of a high time frame premium array in a bearish context, it will keep the highs of the OHLC of the candles intact unless it is what? A run on the high into a fair value gap. That is the only time you expect a run on the candle's high into a fair value gap and then continue down. But you are expecting, right? Other than that, you're expecting the highs of the candles to not be taken. You can get deep into it, into the candle's body. We're not expecting the high of the candle to be taken until you run the draw on liquidity. Now, what I just said here, this is not just for the higher time frame, but I'm gonna go in depth of why this is so beneficial and how this framework is so pinnacle to what I'm gonna show you on an intraday level in a second. But this as well, from a 4-hour PD array, look at, right, when you trade up into a 4-hour PD array, look at your 30-minute candles and what I just taught here. Are the highs being exceeded? Because the thing is, we just look at the candles as candles. But now when I'm showing you like this, right? The candles aren't exceeding the previous one. What does that show you? That shows you where your entries and exits can be. Because let's say, right, and this is how I trade a lot. We traded into a 4-hour PD array and we displaced lower. And I see that the next candle, right, it's not exceeding that candle's high. And it's, clearly it's in line with my bias, bearish, everything. I know that the candle's highs, unless there's a fair value gap, of course, I know the candle's highs aren't going to be, taken, right? So what do? Let me get as close as I can to this candle's, if I can get as close as I can to this candle's high and find an entry there, because I'm assuming that this candle's high is going to be kept intact until the drawn liquidity is hit on my intraday level. That's my trade setup. Do you see my point? Right? Now, how can this help us on the intraday level? Let's go to the 1-hour chart. And just before that, it's a very clear market maker sell model. So your initial consolidation here, move up, retracement down, move up, retracement down, move up higher. And in the market maker sell model, for the people that have done it, chapter 4, lesson 3. Now, if you're not on it, don't rush to it. You'll get to it. Where do I say that smart money reversal occurs? At your higher time frame PD arrays, this is where you hunt your smart money reversals. Now you have your framework on Euro USD, right? And the DXY is also a clear, very clear market maker buy model, right? This is where we're targeting come down. This is the weekly fair value gap close, right? Smart money reversal. Now, where can we expect the retracement to? You see this, right? I want to see the retracement into here. Sweep these lows, retracement into here, and I want to see that offset the move to the run higher, right? Now, on Euro, it's this, right? You see this 4-hour fair value gap from here to here. I want to see that swept up, because look at all these relative equal highs of the candles. Look at the candles, right? High, 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 right? They're flat. When I mean they're flat, this is like, a peak. This is flat. It's just like a straight line you can put across it. And we have a fair value gap. I want to see the move into that fair value gap. Essentially the institutional order flow entry drill, and then I want to see that offset the move lower, right? But let's go on to the hourly so I can delineate the trading days. Now I just want you guys to see something. Look at the delivery from once you trade into your higher time frame PD array. Right, now let's go on a 15-minute chart, because this is essentially going to be a amplified chapter 4 lesson 1. When you have your move into higher time frame PD array, because on the weekly commentary before, I don't know yet how long it takes to trade into an array, but we wanted to see that move into that array, and then our bias from there, we want to see us become bullish again on the DXY, right? If you're confused on what I'm saying, this is essentially what I'm saying, right? You see the move into this fair value gap. I was short, and this is, listen here, I was short until the fair value gap. This is where I'm on my hands. Okay, well, what's going to happen? And then clearly, if we go to a 4 hour chart, we come into it, and what happens is, you know, retracement, and now we're breaking highs essentially, right? Let's go back here. Now, when you have your higher time frame PD array, and stick with me, the guys that are been with me for some time, this is going to be gold to you guys, right? The guys that are learning and you're new, I promise you, just go through everything and come back to this video when in your, don't rush it, but do it properly. And when you come back to this video, everything will click, right? So when we trade into a high time frame PD array, what do we expect now? We expect now to run to our drawn liquidity, right? So how do we expect the days now to form, right? This is the discussion point now. This is how the day traded from midnight to midnight, right? A down close candle. The high of the day was made when? It was made in, 3 a.m. New York time, which is the London open kill zone. Is that not the time of day that we expect the the opposing end of the range to be made? Yes, it is, right? Now, when was the low made? Just after, you know, the New York kill zone, right? 15 minutes after. And that's where the expansion of the range happened. Then we came and we closed. Now that was one day, right? Let's go again and do it from here. Now this is the next day, right? Now, if you're thinking, why is the guy just drawing candles on the thingy? If you're new here, this is all covered in chapter 3. The guys that have been with me, look at the context. Higher time frame PD array. What are you hunting off of your higher time frame PD array? You know everything I taught you in chapter 3, it only makes sense off of higher time frame PD arrays. When you trade off your higher time frame PD arrays, this is what you're hunting. It doesn't make sense to hunt this every single day inside of a choppy consolidation. This just will not, it won't, I'm not saying it won't work, but I'm saying the chances are it's just going to look very trashy, and you're going to have, a protraction that's maybe outside of London, and just an expansion outside of New York and things like that. When you are trading off your high time frame PD array, this is where you go to work. Midnight protraction. London places in the high of the day. Now I taught you many measures. The Asian range, the run on the Asian range, right, which is clearly here, right? This is the Asian range high. Ran it. You can use the CBTRs, right? We're not gonna go into this weekly commentary because it's gonna take too long. But you can use the CBDR to measure the protraction as well, right? Essentially, it's this: the average daily range, right, is usually 100-ish pips for the new guys listening to this. Now, how do we like to do it? That move that is opposite to the true move of the day, the Judah swing, right? We want to see that move away. We have to consider the daily range. That move is probably going to be 30-ish pips to make the high, right? We don't really want it to be more than 30, 40 pips, because on a 100-day daily average daily range, 30 pips goes to the 30-ish pips goes to the protraction, and then we have a long time to work on the full expansion, right? Now, off your higher time frame PD arrays, this is when you're using time of day, right? Now, this is where the step that I'm going to show you guys, and don't lose me here, watch this again, right? We're at the high time frame PD arrays. Now, what are we doing? we are hunting this, right? Chapter 4, lesson 1. We're hunting this. We're hunting the daily candles, right? We know the anatomy of it. It's going to be made, the high made early, and then the expansion for the rest of the day, and then it's going to close, right? And we're hunting this. But, right, now let me remove this. But we are considering it all off what? We're considering it all off of the open, high, low, close of the daily candles. Do you see my point? Right? You have to consider it off of the open, high, low, close of the candles. The highs, if I go back to the 15, you see how the retracement here, it's not gonna go and exceed this candle's high. Do you see my point? Yeah, it might have retraced like deeper into it. It might have got into like here, right? It might have went into like here, but it's not going to exceed it. We don't do that. We want to see that protraction get close because that's going to give us more opportunity to, have a larger range, a larger move in the market to profit from, right? You're expecting that retracement into it. Now, always be so conscious that the open high low, the close of the candle, I'm not expecting it to get run unless there's a fair value gap to fill, right? And just doing this in conjunction with the weekly profiling and daily profiling and using the kill zones and things that the arrays that I've taught you, I promise you this is the complete trading plan. It took me the start of this year to understand the open high low close like this. Well, maybe I didn't have guidance, it was all due to my own studying and whatnot, but regardless, what I'm giving you is 4 years of studying. This alone is very, very powerful. If you can blend what I just showed you, the time of day, the day of the week, and the last piece of the puzzle, the open high low close, off of the high time frame PD arrays. Now, someone in the mentorship approached me yesterday saying, the open high low close like this is legit. Like he was testing it. He was like, I've been looking at moves away from the high time frame PD arrays, the premium discount arrays, right? In context with the market. So like he was looking at the bearish price arrays in Euro USD, I believe, and he was saying to me how like on the 4 hour and the daily, like there is no run on the candle's highs once you're displacing away from it. It just goes towards, it offers a retracement back into the candle's body, but we're not exceeding the candle's high unless there's a fair value gap. And he's like, this is like crazy because now once you can do on the higher time frame, you need to start seeing how can I start using this for the intraday level to me. Now I'm going to say something, but I'm not going to show you yet, right? This is a perfect example. On an intraday level, when that opposite end of the range is made, right, in London here, and you're displacing away, the candle's highs, right, are the candle's highs exceeding the previous candle's highs? No, they're not, right? Look at it. Candle high here, right? This candle's high is intact. That candle's high intact, right? There is no run on the candle's highs until what happens? The close of the kill zone, right? Now go to New York, and what happens is there's a minor move up, and then look at the highs, and then what's here? Fair value gap from here to here. Candles move up to fill it. Once it's filled, what happens? The candles highs again intact, moving down. Fair value gap fill, moving down and moving down, moving down. Even on an intraday level, this happens. But maybe on the intraday level, it's too quick and there's too many candles to consider for you. I'm saying do it from your higher time frame PD arrays using the daily and the 4 hour first. Get comfortable seeing how the highs, the open high low close of the candles are being respected. Find comfort in that and then start to become more advanced and see it on a lower time frame level like what I just showed you, right? Now if we just go like this we could talk about the Euro USD, the weekly draw on liquidity, right? So the opposite of the DXY, we see the move into this imbalance. Now the next candle, I'm expecting it to trade lower down into the sell side liquidity pool here. Same with the pound, we moved up into this order block, and we have a lot more range on the pound to move down right now. US 500 as well, the target I have is this, right? I want to see 3500, this area here, right? There's a little fair value gap in here, and we had this run on the previous week's high. Now look, right, this is a perfect example again. This, right, you see this retracement, you see we're going downwards, we retrace up, premium array. We sweep these two highs into this fair value gap, and then we displace lower. The highs of the candles are intact. There's what left here? An imbalance was left here. The candles come in and they push into it, and then they move lower. There's no imbalance left here. This candle moves down, right? And then this candle comes in a bit and it moves down. What does this candle create though? A fair value gap. This candle comes in, fills that fair value gap. You see how there's only a run on the highs when a fair value gap is left. Other than that, the candles work lower. So what do you expect now? You expect, right, this candle's high to be kept intact and the candles now to push and print lower up until the drawn liquidities hit. This, if you can find comfort in this, is the most powerful thing that I can teach you guys, right? Now, I think we've covered it all pretty much, right? Just to touch on the midweek reversal again. Remember, you're timing the midweek reversals with when price trades into a high time frame price array or it runs a level such as the previous week's high or previous week's low. Only then do you anticipate reversal. Until then, the ideal reversal shouldn't be in your head, right? So that's all for this weekly commentary. Any questions? I know maybe I'll get quite a few questions about the open, high, low, close, but I'm telling you guys, practice it as a back test. If you're new and you haven't even finished the content yet, take your time finish the content. There's so much damn content in this mentorship, 70 plus videos. Finish them all. Take your time. I promise you the worst thing you can do is rush the videos. There's guys from month one that can tell you they rushed the videos and they had to go back and do it again properly. Now, note taking. I tell people, and I tutor outside of trading, I tell the students I tutor every single time, your notes are a direct reflection of how well you understand things. If your notes aren't good, your understanding isn't good. Take grace in your note taking. Do it one time. Learn to love it. Like, learn to love how to study and note taking, and you'll do well in whatever it is you're studying, right? 3 months until the new year. 3 months, you can do 2 videos a day and you can, pretty much catch up to all the content. It's not long. It's just about work ethic. It's just, I just have to remind you guys, right? There's no time to slack off. It's going to be that time where your friends are going to tell you, let's go out, New Year's, whatever, Halloween. Just remember, sort your own goals out first and then think about enjoying yourself. This is the only way you're going to get results, right? Now, for your practice and your back test for this weekly commentary, I want you guys, only if you finish all the content and you're up to date and you're understanding what I'm saying, practice the open, high, low, close off of the high time frame PD arrays and see it for yourselves, right? So until next time, and I'll see you guys in the next weekly commentary.